This line going up and down is perhaps one of the most important things for investors to watch in 2026. It shows the yield on Japan's 30-year government bond, and over the past year it's gone almost parabolic to around 3.5%, a level Japan has never seen before. That move is coming from a country with a $10 trillion government bond market, the third largest on the planet. When long-term borrowing costs spike like this, it usually means something deeper is breaking, and because Japan's bond market is deeply connected to the rest of the world, especially the United States, many economists are warning this move could trigger a broader chain reaction across global financial markets. Japan is the single largest foreign holder of US government debt, with roughly $1.2 trillion, well ahead of other major holders like China and the UK. So stress there could very well spill over into US bonds. But to understand how that spillover could happen and what the real impact might be, we first need to look at why these two bond markets are so deeply connected in the first place. See, the reason Japan holds so much US government debt actually comes down to a single yield problem. For decades, yields on Japanese government bonds have been extremely low, often below 2%, and in some periods close to zero. So Japanese investors naturally looked elsewhere for returns, and the US became the obvious destination. US Treasuries consistently offered double, and at times triple the yield available in Japan, with similar credit quality. But it didn't stop with Japan investors. Global investors also took advantage of this gap by borrowing cheaply in Japan, investing that money into higher yielding US bonds, and pocket the difference. This strategy is known as the carry trade, and for years the trade worked almost effortlessly. However, since 2024, US bond yields have stagnated at around 4.5%. At the same time, Japanese bond yields have surged from around 1% to nearly 3.5%. The potential closing of this gap is what has begun to alarm investors, including Michael Burry, who was warned that a carry trade unwind could ripple through US markets. And it makes total sense. If that gap closes, the carry trade stops being attractive and can quickly become risky. Japanese investors no longer need to take currency risk to earn returns, as they can get comparable yields at home. That gives them an incentive to sell US bonds and rotate back into domestic assets. At the same time, global investors who borrowed cheaply in Japan to fund investments in US bonds may be forced to unwind those positions. And this comes at a particularly hard time for the US government. This year, nearly $9 trillion of US government debt is set to mature. That means the Treasury will need to issue a massive amount of new bonds into the market to replace the old ones. And to absorb that supply, the US relies heavily on both domestic buyers and foreign investors. If bond issuance keeps rising while demand weakens, yields would need to move higher to attract buyers, much like what we've already seen in Japan, and that would tighten financial conditions across the economy. But yields are only one part of the investment decision. The other, and arguably more important, is risk. Right now, US government debt stands at roughly 120% of GDP, meaning total debt is about 1.2 times the size of the economy. That's already elevated by historical standards. But this is Japan's debt to GDP. Its debt burden is closer to 240% of GDP, or more than twice the size of its economy. And that matters because the economy is ultimately what pays the debt back. When debt grows much bigger than the economy, investors naturally see it as riskier. So as it stands currently, Japanese bonds aren't just offering lower yields, they also carry a higher risk compared to US Treasuries. And that may explain why, even as Japanese bond yields have surged, global investors are still choosing US Treasuries. This chart shows how much US government debt is held by foreign investors. Since 2024, that figure has actually increased by roughly $1 trillion. In other words, while stress in Japan's bond market is real, it hasn't yet triggered a broad flight away from US debt. So any spillover of a full-blown US debt crisis doesn't look imminent, at least not right now. But the bond market isn't the only place where a potential unwind of Japan carry trade could show up. As this chart shows, Japanese investors collectively hold around $2.2 trillion in US assets. About $1.2 trillion of that is invested in US government bonds, which means roughly another $1 trillion is sitting in US equities. And importantly, a large portion of those investments has been funded by debt. That works well when interest rates in Japan are near zero, like they were for years, but it becomes far less attractive when those borrowing costs start rising quickly, especially if the return on US stocks no longer compensates for the higher interest investors have to pay back. And indeed, when we overlay the earnings yield of S&P 500 on top, we can see that for the first time since the 2008 global financial crisis, Japan's 30-year bond yield has risen above the earnings yield of US stocks. The earnings yield is a simple way to think about stock returns. It tells us how much profit a company generates for every dollar invested. So when Japanese government bonds start offering a higher yield than US equities, the risk-reward balance changes. At that point, holding US stocks looks less compelling, especially especially for investors funding those positions with borrowed money. So far though, we haven't seen a full unwind of the yen carry trade. Despite the jump in Japanese yields, the S&P 500 is still hovering near all-time highs. One reason often cited is the yen itself. The Japanese yen has remained relatively weak against the dollar. A weak yen lowers the effective cost of borrowing for Japanese investors and helps offset higher interest rates. On the contrary, a stronger yen combined with higher Japanese interest rates is what really squeezes the carry trade. That's exactly what we saw in August 2024 and March 2025. Both carry trade drops coincided with double-digit corrections in US equities. So if Japanese yields continue to climb and the yen starts strengthening at the same time, the risk of a broader carry trade unwind rises, and that could put pressure on US stocks. But when you put the size into perspective, the carry trade tied to US equities is estimated at around $1 trillion, or roughly only 2% of the S&P 500 market cap, which is why some analysts argue that any unwind is more likely to trigger short-term volatility rather than a structural bear market, especially if it doesn't coincide with a broader debt or credit crisis. At Capital.com, we'll keep tracking how global bond markets, currencies, and cross-border capital flows are shaping risk across financial markets. Hit like and subscribe to stay tuned. Thanks for watching.